What's up everybody, Gen X Dividend Investor here. In this video I'll be answering 7 subscriber questions which cover a bunch of really interesting investing topics. Then I'll end this video with an inspiring life story that is worth hearing and reflecting on. If you would like me to potentially answer a question of yours in a future Millionaire Dividend Investing questions and answers video, then follow me on Instagram at Gen X Dividend Investor and DM me your questions. Please consider hitting the thumbs up button, subscribing if you haven't, and click that bell notification. Finally, I'm not a financial advisor, so take my responses as entertainment only, not as a way to make financial decisions. Okay, the first question comes from Hank, who said, "Hi Gen X, I really loved your video where you bought almost $500,000 of dividend stocks. I've never seen anything like that firsthand. How are those positions doing today? I rarely hear people circle back on what they buy and was interested to know. Thanks again, love your channel, Hank." Thanks, Hank. So it's not quite been 2 months since that video, and thus I personally don't put too much focus on short time frames like that when investing. But since you asked, let's take a look at what I bought, at what prices, and see what they're at today. Here's a spreadsheet I just threw together, listing the positions I bought in the order that I bought them in the video. So here I put the number of shares purchased, the ticker, the average price I paid per share, the total price I paid, and today's price and today's value. And then I put the overall profit and the increase or decrease. And this is not counting dividends. So for example, J&J, 30 shares, and paid $163.57. So it's basically putting about $5,000 into J&J. And today's price, it's actually gone down a little bit, and so that is down 1.88%. And then I bought 166 shares of AbbVie at $102 a share, and today it's $105.90, and so that's up 3.82%. So I bought 467 shares of Chevron at $85.51 for a total of about 40 grand. Today Chevron's at $102.54, which means it's worth about 48 grand. And so Chevron's gone up about 19.92%. I bought 1,009 shares of ExxonMobil at $44.60, so about 45 grand. Today it's at $55.91, which means it's up about 25%. Then I bought 449 shares of JPM at $129. Today it's about $151, so JPM's up about 17%. And then I bought 2,434 shares of AT&T at $28.77. Today it's about at $30, which is up 4.24%. And then I bought 1,270 shares of Philip Morris at $78.68. Today it's about at $90 a share, which means it's up about 14%. And finally, I bought 2,829 shares of Altria at $40.64. Today it's at $51.64, so it's up 27%. So altogether I put in about 450 grand, and today it's up to about 527 grand, which means it's up 78 grand, which is about 17.38%. So just to compare, I also showed what the S&P 500 was at that time, and with about the same amount of money, I could have bought 120 shares of it, or about 452 grand's worth. And today that would be worth 472 grand, which means it went up 4.44%. So that's kind of a nice delta there to beat the market by about a factor of 4x. So this is an example of buying some things that are at good prices and buying when others aren't. Oil was out of favor, and so its prices were down. Sin stocks were out of favor, banks too. Now those returns were way higher than I'd anticipate over such a short time frame, and I'm personally happy if I just am roughly in line with the market in terms of returns. Honestly, I just like planting more money trees and not too concerned if I have some bad weather for a while, nor do I get too excited if they do bad or worse than I anticipate. I like acquiring more assets, aka shares, in companies I'm confident will provide me with positive cash flow. That excites me a lot more than getting a new pair of shoes or a car or whatever. I'll take 250 grand in stocks any day over a Lambo, and I used to be a car guy. Sure, a Lambo is fun, to me at least, for a short period of time. I think my dividend stocks will be appreciated for generations to come. Okay, let's move on. My second of 7 questions comes from George with a J, who asked, "You're a multimillionaire. Why make YouTube videos? Why not just drink pina coladas on the beach in Mexico?" Hey George, or maybe it's Jorge, I'm not sure, and I apologize if I mispronounced your name. So I'm the type of person who gets in an Uber and tries to influence the driver to open a Roth and start investing in VTI or VU before the ride is over. What I mean is that I get great satisfaction influencing people to learn about the miracle of investing, and in particular in dividend investing, as I know it can get you on your path to freedom. Freedom from financial stress, from work stress, freedom to choose what you want to do with your time. I'm like most people in that I had no financial literacy. I had no relatives who invested in the stock market, and I recognize they don't teach this stuff in school. So what started as a channel to teach my kids about how their dad invests has evolved into a fun passion project. Sipping pina coladas on the beach is great, but even greater fun, at least for me, is helping change someone's life in a positive way. Though I still like going to the beach sometimes. Okay, let's move on. My third of 7 questions comes from Kip, who asked, "Hi Gen X, I love your channel and have been watching since you began. This pandemic has got me thinking that it seems like the stock market is decoupled from the economy. Why is that?" Hi Kip, and thank you. Well, one reason is that the stock market is forward-looking, whereas the economy is now. It's forward-looking because investors often try to price in where they think companies are going. So here we are in the midst of a pandemic, and the stock market is believing that they see the light at the end of the tunnel, and they're operating under the assumption that the vaccines will continue to work and the trends will continue to improve. On the other hand, the economy is reality, not a forecast of future earnings. Another reason that the stock market is decoupled from the economy is that the market is often made up of large public companies that have better access to capital than small mom-and-pop private companies, even though small companies represent like half the jobs in the US. It's often harder for small businesses to have the same benefits as large companies, and these days it's been especially harder for small businesses in the hospitality, retail, and travel industries due to the pandemic. So for people who have jobs in businesses that have been impacted, their financial realities can be starkly different than the stock market. Another reason there's a decoupling is because people often buy and sell due to their emotions or due to short-term news. Benjamin Graham, aka Warren Buffett's mentor, has a saying which is that in the short term the market is a voting machine, and in the long term it's a weighing machine. What that means is that in the short term, a stock goes up or down because it's a popularity contest with people voting for what they think with their money. But in the long term, the real value of the stock gets reflected in the price as the short-term gyrations lose out to long-term intrinsic value. So another reason you see a decoupling is that these short-term price gyrations are being impacted by that effect. Another reason is that the majority of stock market assets are held by a minority of people. So while it's true that about 55% of the people in the USA hold some sort of stocks in a 401k or somewhere, I saw an analysis that said the top 1% of Americans in terms of net worth controlled about 38% of the value in stocks. So that wealth disparity further can explain why the stock market is decoupled from the economy. Okay, let's move on. My fourth of 7 questions comes from Luke, who asked, "Hi, I subscribe to your YouTube channel and enjoy watching your videos. We have similar investing philosophies. I'm only 33, so a bit younger than you, but our dividend portfolios are constructed similarly. Mine's only worth about $350K though. Question for you, are there any stocks you would recommend for a long-term dividend growth portfolio that you don't already own?" Hi Luke, thanks, and I wouldn't say yours is only worth $350K. $350K is awesome. Don't compare yourself to me or to anyone. There's always going to be someone with a larger portfolio than you and someone with a smaller portfolio than you. The only person you should be comparing yourself is to yourself from yesterday. Anyways, there are lots of great dividend companies I don't own, like Hormel, Clorox, Lockheed Martin, Visa, and Walmart, just to name a few. I don't own them for a plethora of reasons, from either not seeing buy points I like or them not aligning to the vision of where I'm taking my portfolio or whatever. I personally like to fight against the urge to keep adding new positions to my portfolio, as the more I add, the less time I have to stay close to my businesses, so instead I usually focus on adding to my existing positions. Okay, let's continue. My fifth of 7 questions comes from Francis. He asked, "Hi, I saw your video where you invested like almost $500,000 into dividend stocks, and you also said you put a down payment on a house. Could you have just paid off the house instead? If so, why didn't you do that?" Hey Francis, so I could have paid off my recent house purchase using that investment cash, plus some spare cash on the side, but I decided instead to put 20% down and get a 30-year mortgage at an incredible low interest rate of 2.625%. I wanted to put 20% down on my 30-year fixed mortgage to avoid needing to get PMI, aka private mortgage insurance, which is usually required if you have a conventional loan and your down payment is less than 20% of the purchase price. I like the stability and less stress of a 30-year fixed over any other types of loans because the lack of volatility allows me to plan my financial needs better, and it's amazing to know I'm locked into so low. So the reason I didn't outright buy my house with cash was because I felt if I invested that cash I could be at a 2.625% return over long periods of time. Between stock appreciation and dividends, that's normally been a pretty easy thing to do historically. Now, I don't fault people for paying off their house, because that can be a big stress relief that might make it worth doing, and paying it off can be more of a guarantee than your dividends. I actually considered buying my house outright to keep things simple for my wife and kids if I croaked, but in the end I felt the path that we took made most sense for my family. Okay, moving on. My second to last question comes from CryptoKid19, who asked, "Hi Gen X, I heard you recently say that you're long in Bitcoin and Ethereum. Have you ever considered going into any altcoins?" Hi CryptoKid. I actually did mention on my private channel on my Discord, one that's reserved for my Patreon aristocrats and kings, that I got into Cardano and DOT. So some quick info. Cardano and ADA was created by Charles Hoskinson, who is the co-founder of Ethereum and BitShares. He apparently left the Ethereum team after thinking things should go in a different direction than it was heading. The platform he created, called Cardano, is named after Girolamo Cardano, a famous Italian mathematician, and his crypto is called ADA, which is named after Ada Lovelace, who some call one of the world's first programmers. The Cardano team claims that Cardano overcomes the existing problems in Bitcoin, which is that Bitcoin is too slow and inflexible, and Ethereum is not safe or scalable enough. At the time of creating this video, we see that Bitcoin has a market cap of over 1 trillion, Ethereum is at 206 billion, Binance Coin is at 40 billion, Tether is at 39 billion, Cardano ADA is at 38 billion, and Polkadot is at 34 billion. Polkadot was founded by a team that includes Gavin Wood, who was also a co-founder of Ethereum. Wood came up with a vision for Polkadot, which was meant to help support the decentralization of the web, which Wood coined as Web 3.0, which could be a way for the web and data to be more controlled by individuals rather than a few huge corporations, which is, to put it mildly, huge. Polkadot is a new protocol that allows any data, not just tokens, to be transferred across blockchains and will better address some of the scalability concerns with Ethereum, which itself is evolving to tackle some similar issues. Beyond ADA and DOT, I also hold a bit of Enjin and some others. Enjin is just a fun coin used for virtual goods and some online games, and since I've been a gamer since I was like 7 years old, I had to get some. Anyways, please remember, everybody's particular financial situations and risk tolerances and beliefs about the future are their own. I put a small portion of my investable money into gambling moonshots like altcoins, though obviously can't recommend you do the same. I also don't plan to go in-depth on crypto stuff on my channel, but since multiple people asked me about the same question, since it's tied to passive income, I thought I'd answer it. Specifically, I plan to stake my Ethereum on Coinbase and then get some yield on my altcoins that I hold in Voyager. Here is Voyager's APR they published in March, so if you hold at least 25 DOT, then you can get an 8% return, or if you have at least 1,000 ADA with them, then you can get like 5.25% interest on it. They currently offer monthly compounding on the top 24 cryptos with no staking lockups. Okay, last question. This came from Lorenzo, who said, "I'm a university student and I'm looking forward to investing some money I saved up, around 10,000. I really like the idea of a dividend portfolio, especially because they provide a somewhat steady cash flow and they usually outperform the market, also in recessions. However, I believe that this is not a great time to start investing. Stocks are trading at a PE of 39 and all the indicators of an imminent crash are present. As you said in one of your recent videos, more money has been lost trying to predict a crash than in the crashes themselves. However, I really do not feel happy about investing in stocks now. I was instead thinking about buying Vanguard bond ETFs, and when the crash comes, if it comes, I would hope to transform the bonds into dividend stocks. I hope you can give me your opinion on this. I really appreciate the content on your channel and the time you put into reading this message. Thank you, Lorenzo." Hey Lorenzo, thanks for your nice message. I understand your trepidation. I also think the market's too hot and it's run up too much, and I could argue a crash is around the corner. But I could also argue that all the stimulus money and massive pent-up demand by people who want to go out and buy stuff, go to movies, travel, food, etc. is like a spring about to be released as the vaccines hopefully continue to work. The market is too hard to consistently predict. So I usually advocate for people to pay off high-interest debt like credit cards, have multiple months of an emergency fund, and then invest in non-crap what they can afford to lose. I say non-crap simply to mean if you invest in reasonable stuff over long time frames, I believe you're going to do okay. If you're chasing crap like penny stocks, then I fear you might not do as well. I'm not a Bond fan, other than James Bond, who I love and have loved since I was a kid. Side note, I read that the release of the next Bond film is now scheduled for October 8th, 2021, delayed from the original planned release of April 2020. I can understand though why people like bonds in especially volatile times. I personally believe that my mix of companies will do better than bonds over the long run, so I take that risk. I believe that my McDonald's and Apple and blah 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 will do better for me than bonds. I also think it's smart to take more risks when you're young, because you often have more time to recover in your life. So I'm even less of a bond fan for young people. I personally don't plan to ever hold bonds, not when I'm 90 and not when I'm in my 40s like now. That doesn't mean you should do that, it's just me. But if the market crashed 50% tomorrow, I also wouldn't lose sleep over it. I wouldn't be telling myself, damn, I wish I had put money in bonds. I instead would be happy that I had invested in quality assets and would tell myself that decades from now I'll probably just wish I had invested more, not that I wish I'd put more money in bonds. It's okay for you to do whatever you feel makes sense for you. If it helps you sleep better at night to be 90% in bonds and 10% in stocks, do that. And in the short term, that's probably safer than going all in equities. But I personally just ride the stock waves and deal with the crashes as they come. Okay, I hope you guys like those various questions. Now I want to share a valuable life story, so listen carefully. There once was a very wise man living in ancient times. He was elderly and educated and held knowledge and books to the highest regard. One day while on a walk, he realized that his shoes were really starting to wear out. Because he spent a lot of time walking on a daily basis, he knew he had to find the best shoes to support and protect his feet. The man didn't want to make things worse by purchasing the wrong shoes and having inadequate protection, which would lead to injuries and the inability to leave his home and walk to find new books to read. The man gathered all of the books he could that were written only by those that he admired the most to search for the answer to his question, what do I do if my shoes have fallen apart? He read through several books for many hours before finding out that he had no choice but to go buy a new pair of shoes. He then spent a lot of time reading about how to know if a pair of shoes fit properly. Once he was satisfied with the answers he found, he was proud of himself for doing the research and he felt confident in his ability to buy a high-quality replacement for his old shoes. He figured if he hadn't done his research, he probably would have gone barefoot for the rest of his life, as he had no one to tell him how to fix his shoes. Following the book's instructions, the man took a stick and measured his foot with it. He then went to the market and finally came up upon a pair of shoes that he liked. However, he realized he had left the stick back at home, which was far away from the shop. By the time the man returned to the market, the shop was closed, and by that point his shoes were completely split, so he had to return home barefoot. The next morning he walked back to the market with bare feet, but the shoes he had chosen the day before had been sold. The wise man explained what had happened to the shopkeeper, who reacted with a sense of surprise, asking, "Why didn't you buy the shoes yesterday?" The wise man replied, "Because I forgot the stick that I had used to measure my feet back home. And anyone who knows anything about shoes knows you have to have the correct measurements of your feet before you can buy shoes. I didn't want to buy the wrong size, and I was following the normal instructions." Even more confused, the shopkeeper asked, "But your foot was with you. Why didn't you just try the shoes on?" The wise man was equally confused in return and responded, "All the books say shoes must be bought with the exact same measurements of the shoes you already own." Laughing, the shop owner replied, No, you don't need the advice from books to buy shoes. You just need to have your feet, some money, and some common sense to not complicate things." Moral of the story? Sometimes you need to take action without overthinking things. Knowledge often comes in handy, but in some circumstances, if you lack experience or common sense, your knowledge will only get you so far. In fact, it could make things seem a lot more complicated than they actually are. If you're facing an issue, don't forget to use your reasoning skills in addition to anything you've learned in a formal learning environment. Investing can sometimes be the same. It's good to research things, but also use your common sense and take action. Okay, moving on. I'd like to shout out a couple of my latest Patreon aristocrats who have recently signed up. So thank you STFXGO, thank you Dryston, and thank you Glenn T78. As an aristocrat, they gain access to my new dividend spreadsheet and to multiple private channels on my Discord, including one where I sometimes talk about my growth portfolio and I let people watch my videos before I release them to the public, as well as I often let you vote on which thumbnails I should use for my new videos. And thank you to you, the viewer, for watching my video. Please consider hitting the thumbs up button, subscribe me if you haven't, and click that bell notification. I highly recommend you join my free dividend Discord chat server, which has thousands of dividend investors on it and is growing all the time. Finally, if you'd like me to potentially answer a question of yours in a future Millionaire Dividend Investing Questions and Answers video, then follow me on Instagram at GenXDividendInvestor and DM your questions. Thanks, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.